Welcome to Talk Tickers. You're tuning in for a deep dive into the latest earnings call from CAME.
Yeah, think of this as your shortcut to understanding what really matters from that call.
Okay, so let's jump right in. How did CAME's first quarter of 2025 look?
Well, overall, pretty strong. They actually beat expectations in a few key areas.
Oh, good start.
Yeah, and that led to better profitability compared to the previous quarter. Specifically, earnings per share were $1.25.
The $1.25 EPS.
And net income hit $172 million.
Got it. Now, Q1 often has those seasonal deposit outflows, right? How do they handle that?
Right, exactly. And despite those typical outflows, their non-interest-bearing balances, the deposits they don't pay interest on, held up really well.
And that helped their net interest income.
Big time. It helped push their net interest income above what they'd guided for.
Interesting. What else stood out in the headline numbers?
Well, the movement in the interest rate curve actually gave them a bit of a boost.
How so?
It positively impacted their tangible common equity ratio. That's a key strength measure, and also their book value.
Okay, balance sheet strength looking good then.
And they kept up their conservative capital management. We saw growth in their estimated CET1 ratio, which is another capital adequacy measure.
Sounds prudent. And what about shareholder returns? Always a key point.
Yep. They returned $143 million to common shareholders. That was through a mix of share buybacks and dividends.
Okay, $143 million back to shareholders. But was it all smooth sailing?
Not entirely. They did mention customer sentiment dipped slightly.
Oh, why was that?
They put it down to increased macroeconomic uncertainty, which, isn't too surprising given the current climate.
Yeah, that makes sense. We're hearing that from a lot of places. Did that uncertainty show up anywhere else, like loan demand?
It did, actually. Loan demand was described as muted.
Muted, okay.
Specifically, they saw declines in national dealer services and also commercial real estate. And that led to a modest drop in average loan balances overall.
Right. But you said net interest income was strong. How did that work with lower loan balances?
Good question. So despite that dip in loans, they managed to keep net interest income stable.
How?
It seems like good deposit trends were a big part of it. Plus, they got benefits from ending BizWe usage and also from their swap and securities portfolios.
So other parts of the business kind of picked up the slack?
Essentially, yes. And interestingly, their net interest margin, basically their core profitability on lending, actually expanded.
Expanded by how much?
By 12 basis points.
Wow, okay. That's pretty significant.
It definitely suggests they're getting more profitable on each dollar lent relative to their funding cost.
And credit quality, always crucial.
They describe the portfolio as resilient. Net charge-offs did tick up a little bit, but they stayed at the low end of what CAME considers their normal range, which is about 20 to 40 basis points.
Okay, so an increase, but still within expected boundaries. That's reassuring. What about income outside of interest, non-interest income?
That actually grew, although they did point out some, seasonal pressures and some customer-related headwinds there too.
Got it. And expenses?
Expenses were down. Non-interest expenses declined.
Always good to hear. Why was that?
Partly efficiency efforts paying off, and partly just a bit of a slowdown in general business activity.
Okay. So let's wrap the snapshot. Strong quarter overall, good profit, well-managed capital, but maybe some caution flags around loan demand and sentiment.
That's a fair summary, yeah.
Yeah.
Their estimated CET1 ratio ended at 12.05%, which is comfortably above their target.
Right. Let's dig deeper then. Starting with those loans. You said average loans were down less than 1%, driven by dealer services and CRE.
Exactly. For the national dealer services, it was lower floor plan balances. The financing for dealership inventory.
Right. Suggests maybe dealers are being a bit cautious.
Could be, or maybe managing inventory more tightly. And in commercial real estate, it was mostly loan paydowns driving the decrease.
Any bright spots in loans?
Well, they did mention car sales for their dealers. Saw an uptick towards the end of the quarter, so maybe some positive momentum there.
Something to watch.
But overall, loan commitments were also down. Again, mainly led by commercial real estate, maybe reflecting tighter underwriting or just less demand for new projects right now.
And the yield on loans dipped slightly?
Yeah. Average loan yields decreased by 12 basis points. They said that was due to lower market rates generally and also some impact from not accrual interest.
Okay, makes sense. Let's switch to deposits then. You said they outperformed guidance even though they decreased overall by $1.4 billion. What drove that outflow?
Mostly came from running off some brokered time deposits. those tend to be higher cost anyway, and just those normal seasonal outflows you see in Q1.
But the non-interest bearing deposits were the key.
Absolutely. They stayed strong at 38% of the total deposit base. It's a really valuable, stable funding source for them. Doesn't cost them any interest.
Yeah, that's a great percentage. And they're managing deposit costs down too, a 26 basis point drop in pricing.
That's right. They talked about proactive pricing strategies. So they're actively managing the rates they offer.
Smart.
And they also mentioned they're continuing to invest in their deposit products, the processes behind them, and the people involved. Suggests a long-term focus there.
Makes sense. Okay, how about the securities portfolio? It increased slightly.
Just a bit, yeah. It wasn't really big purchases. It was more that the unrealized losses on their existing holdings decreased as rates moved.
Ah, so the mark-to-market improved.
Exactly. That improvement offset the natural paydowns and maturities happening in the portfolio. And they expect future repayments and maturities to keep helping their AOCI accumulated other comprehensive income.
Are they planning to reinvest that cash heavily soon?
Doesn't sound like it.
No.
They indicated significant reinvestments probably won't happen until later in the year. For now, mostly just replacing maturing treasuries.
Maybe waiting for better rates or better uses for the capital.
Could be either or both. They might see better returns in loans eventually, or maybe share buybacks look more attractive right now.
Which brings us back nicely to net interest income. Stable, better than expected. So strong NIB deposits and good deposit pricing really carried the day against lower loan balances.
That's the story, yes. Yeah. And they also pointed out a structural benefit they're already seeing from repositioning their securities portfolio back in Q4. So those moves are paying off.
Interesting. And they sound pretty optimistic about NII going forward.
They do. They see continued promising trends. Their whole interest rate strategy is designed to kind of protect profitability from big rate swings.
Asset neutral, basically.
That's how they described it, yeah.
Right.
Asset neutral. And they even suggested they could potentially benefit if rates were to fall.
Okay, let's pivot to credit quality again. Charge-offs up slightly to 21 basis points, low end of normal. What's the underlying pressure?
They mentioned persistent inflation, and those elevated interest rates are, squeezing customer profitability a bit.
Understandable.
So that's leading to what they expect to be some normalization, some increase in criticized loans they're watching more closely.
It's still low historically.
Very much so, yeah. Criticized loans are still well below historical levels.
Mm-hmm.
And non-performing loans, the ones that are really in trouble, remain well controlled.
Okay. So a slight increase in caution, but no major alarm bells? What about the allowance, the money set aside for losses?
That actually decreased slightly.
Decreased, even with the pressure.
Yeah, because the overall loan balances were lower, credit metrics were generally stable, and their economic forecast is, relatively benign. However, they did increase their qualitative reserves. That's the part based more on management judgment about potential risks. So the net effect was maintaining their coverage ratio at 1.44%.
Okay, so a bit of a balancing act there. And they're watching supply chains?
Yeah, keeping a close eye on potential impacts for their customers.
Got it. Non-interest income up $4 million, but mostly due to not having that loss from last quarter?
That's the main driver, yes. If you strip out the securities repositioning loss from Q4, other non-interest income lines actually saw some declines. CVA credit valuation adjustment was down $5 million due to rate and commodity price moves.
Okay.
And there were some other seasonal or non-customer related declines too. But they stressed that growing customer-related fee income is still a priority.
And on the flip side, non-interest expenses were down $3 million. What saved money there?
Lower litigation costs, less spent on charitable contributions, and lower consulting fees were the main things.
Okay.
Those savings more than offset the usual seasonal bump in salaries and benefits, and also an increase in that FDIC special assessment that all banks are paying right now.
Right, that FDIC charge.
And they also saw lower outside processing costs, which kind of ties back to that slightly slower business activity we mentioned. Expense discipline is definitely a key theme.
Okay. Lastly, capital. CCT1 at 12.05%, well above target. And the rate moves helped the tangible common equity ratio.
That's right. The movement in the forward curve reduced those unrealized losses sitting in AOCI.
Which flows through to equity.
Exactly. Boosted the tangible common equity ratio by a hefty 82 basis points and helped grow book value per share.
Nice boost. And they might buy back more shares in Q2.
They indicated it's possible, yeah. Potentially at a similar pace to Q4 2024. But, and this is key, it depends on market conditions. They'll be opportunistic.
Makes sense. Okay, let's look at the outlook for the rest of 2025 then. What's the overall tone?
Acknowledging uncertainty is definitely part of it.
Yeah.
Their base case assumes uncertainty starts to ease up a bit, and we see slower GDP growth, but importantly, no recession.
Okay, no recession baked in. What does that mean for loans?
They're projecting average loans to be down 1-2% for the full year.
Down for the year.
Yeah, with a slight further decrease expected here in Q2 before they see growth picking back up in the second half.
Okay, so a back half recovery story on loans. What about deposits?
Average deposits expected down 2-3% for the full year. That's mainly driven by running off those brokered CDs we talked about.
Higher cost stuff going away.
Right. They expect Q2 deposit levels to be relatively flat compared to Q1, and they think that strong mix of non-interest-bearing deposits will stay pretty consistent.
Okay. And the big one, net interest income guidance.
They actually raised it, now expecting a 5-7% increase for the full year.
Wow, raised guidance for NII. That's positive.
Definitely. They see Q2 NII being pretty similar to Q1, implying growth ramps up later in the year.
And non-interest income and expenses for the year?
Non-interest income is forecasting about a 2% increase for the full year. Expect Q2 to be stronger than Q1, with customer fees driving that.
Okay. Mm-hmm.
And they noted some regional differences, like maybe a bit more caution in Michigan compared to Texas, for example.
Interesting.
But the long-term view is still good. They see the pipeline building, and again, no recession in their forecast.
What about CRE, commercial real estate worries?
They actually sounded a bit less concerned than maybe previously, saw it as less of a headwind, deal flow even picking up a bit, hoping for stabilization in the next year.
Okay. And deposit costs. Sounds like they feel good about managing those down.
Very much so. Highlighted their success already and see more room to cut costs, especially if market rates fall. Plan is to get rid of the remaining brokered CDs by year end.
And keep gathering core deposits.
Yep, proactively gathering interest-bearing deposits directly.
Any change on the Direct Express program?
Nope, no change to the outlook there. Don't expect any impact in 2025. Focus is really on deposit growth and other business lines.
Okay. And the NII trajectory through the year, just steady growth.
That's the expectation. Steady growth driven by, well, deposit growth, that second half loan growth pickup, and benefits from maturing swaps and securities rolling off.
Makes sense. Any more detail on credit stress? Criticized loans.
Just reiterated, the overall environment is strong and stable. That slight uptick in criticized, mainly CRE, they said. C&I portfolio is stable, but they're watching for any supply chain issues.
Right. And share purchases, more color on the opportunistic part.
Just that they could be active, maybe up to Q4 24 levels, but it really depends. Market conditions, rates, credit performance, loan demand, all factors.
So keeping their options open. Do they have flexibility on expenses if revenue disappoints?
They said there's some flexibility, yes. They can calibrate spending. But they also stress they're committed to key investments.
What about M&A? Are they looking to buy or sell?
Focus is still on independence, they said. They see the M&A environment as murky, maybe limited activity for the next year, year and a half. Organic growth is the main game.
Including expanding into new markets.
Yeah, expanding in existing and potentially new markets organically.
When might they start reinvesting those securities portfolio proceeds more heavily?
Probably more likely in the fourth quarter. Depends on balance sheet size and liquidity needs. Right now, buybacks and loan growth seem like better uses of capital than big securities moves.
Any specific higher risk portfolios they called out?
Yeah, they mentioned keeping a close eye on leverage lending and automotive. Also watching sectors like manufacturing, especially those using steel, aluminum, plus wholesale retail trade and consumer discretionary.
Standard watch list items, mostly. Capital markets income.
Expecting that to pick up through the year, driven by syndications, risk products for clients, and their developing M&A advisory business.
And the dealer portfolio, again, supply chains, tariffs.
Monitoring it, yes. But the dealers are generally well prepared for those kinds of challenges.
What about that efficiency ratio goal, getting back into the 50s?
Yeah, a long-term goal. They see that happening primarily through revenue growth over the next few years, rather than just aggressive cost cutting.
Interesting. Any other business lines highlighted?
They did mention their environmental services business seeing strong, steady growth there, both in waste management and renewables.
Okay. And one last check on those non-interest-bearing deposits. Still feels secure.
They're watching them closely, acknowledging higher rates create pressure, but they think lower rates eventually, plus economic growth, should be positive tailwinds. Treasury management services is a key focus to support that.
Okay, great detail. Now, for our regular disclaimer, This is not financial advice, but we like to toss around an outrageous but plausible trade idea based on the call. What have you got this time?
All right, so disclaimer, firmly in place. Given CAM's solid capital, the potential for more buybacks, and that cautious optimism for loan growth later this year, here's an idea.
Lay it on us.
Consider going long CAM.
Sure.
But to hedge some of that broader regional bank risk, especially around CRE, maybe pair it with a short position. Not on a specific bank, perhaps, but maybe a basket or an index of regional banks that are more heavily exposed to commercial real estate, particularly in markets showing more softness, like maybe the Midwest, which they mentioned.
Interesting pair trade idea. So betting on CAM's specific strengths versus regional headwinds?
Sort of. The idea is to capture CAM's potential upside from their diversified business and solid underwriting if things improve like they forecast.
Right.
While having some protection if those CRE headwinds get worse regionally and drag down less diversified peers.
Okay. Capitalize on CAM's execution, hedge the sector beta a bit. Plausible. Definitely outrageous for us to suggest specifically.
Exactly. Purely speculative. You absolutely need to do your own homework, your own thorough research before even thinking about something like this.
Couldn't agree more. Do your own research. Okay, that wraps our deep dive into CAM's latest earnings call.
Yep. We've tried to pull out the key insights, give you the important takeaways without you having to sit through hours of commentary.
So, what stood out most to you listening along? Any questions this raised? Keep digging, keep exploring.
And join us next time on Talk Tickers for another look beneath the surface of the latest earnings calls.